All right, so day 3 of my journey to a $500,000 stock market portfolio. Not good. My equity in my margin account dropped to 5,300. So during the day I was at over 7,000, almost 8,000. Now I'm at 5,300. That can be explained by Weight Watchers, which jumped from $20 to $30 in 2 days. This is a stock that I bought at $30 a while back, and I sold a call option at a 28.5 strike, collecting $3.60. So my cost on this was 26.5 or 26.4. And then the stock dropped to 19 after the first cover call trade I made. So the following month, I sold a call option at a closer strike price at a 25 strike. So I kept selling call options at a 25 strike. Remember, I bought the stock at 30. My true cost is 26.4. My original strike that I sold the call option at was 28.5. So I don't want to sell the stock less than 28.5. But now, for August 16, the option expiring August 16, I chose a 25 strike. And I only collected $25 or 25 cents. But because the stock shot up from 20 to 30 in 2 days, so now I'm in big trouble because, as you can see, the option is worth $5 if I want to close it. So it's showing a loss of $938. So now I'm going to have to sell my shares at 25. So basically, I bought the stock at 30. My true cost is 26.5, and I've held it for maybe 5 months. And at the end, I'm going to sell it at a loss of $1.40. The loss is actually bigger because I actually held it for 4 or 5 months without doing anything with it. And I actually paid interest on half the amount. Since it's in my margin account, so it's part of it is borrowed money. And Weight Watchers actually, it has a 50% margin requirement. So 50% of it is my cash or my equity, and 50% is borrowed money. So I paid half of it in interest. So I have a couple options. Well, I still have until August 16, so I could just hope that the stock drops below 25 come August 16, so it's got a week. Or what I could do is accept to let my shares go at 25, but that would be sort of a loss because I gained nothing from holding this position and I just wasted time. But most likely what I will do is I will buy back the call option. So I'm going to spend $4 or $5 per contract so that I can sell another one for the following month. So for September 20th, and I'll choose the same strike. So basically I'm rolling over to the following month, but keeping the same strike. So that's going to give me, actually, I could probably collect maybe 80 cents or 90 cents per contract. So by rolling over at the same strike for the following month, I can collect 3% return, which is very good. But I'll still have the risk that the following month, the stock will most likely be above 25. So I'm going to have to do it again. So I can keep doing that until the stock drops below 25. So I think that's probably my best option with this, because I don't want to sell it at 25. It would be a complete waste. It's not going to be a major loss. I would probably lose around maybe $2 a share, and I've got 200 shares, so I'd lose around $400. But I would feel like I wasted all this time trying to sell call options on the stock, and at the end it all gets wiped out because I chose a lower strike price than my cost. I should have just stayed with the 30 strike price and maybe collected a smaller premium, or maybe even gone further out just to be safe. So yeah, so most likely I'm just going to roll it over. So buy back the call option so that my shares don't get taken away at 25, and then sell at the same strike price for the following month another call option. And as you can see here, it would give me a credit. So mid price between 20 cents and $1.70. So maybe about 80 cents. And hopefully between now and September 20th, it slowly comes back down to 25. If it stays above 25 again, I'll just have to repeat the process, buy back the option and then close it out, buy back the option and then sell another one. In fact, if I go calculate how much I've received in call options from this trade from Weight Watchers, so what is really my true cost after all the premiums collected? Here, let me go calculate that. So I'm going to go to my accounts. I'm going to go to account activity. I'm going to pick a range, let's say January 1st, because I think I bought it in February. So it's been like 5 months. I'm going to go to my margin. I'm going to view all. Then I'm going to search on weight. All right, so initially I bought the stock at 30 and I sold that at 28.5 strike. I collected $3.60. So 30 minus 3.6. So my cost initially was 26.4. That's my cost without making profit, without losing money. And And then the following month at a 30 strike, I collected 15 cents. So 26.4, I'm going to deduct 15 cents. So now my cost is 26.25. And then the following month, I sold at a 22.5, I collected 70 cents. So minus 0.7, my cost is now 25.55. But I also bought back the option at the 30 strike, probably to sell the next one at 22.5 when the stock dropped hard. So I'll have to add that to my cost, so 10 cents, so plus 10 cents. So now I'm at 25.65. And then I sold at a 25 strike, collected 15 cents. So minus 15, I'm down to 25.5. And then collected another 25 cents at a 25 strike. So my true cost is 25.25. So if I actually sell, if I let my shares go at 25, I lose 25 cents per share times. So I lose 25 cents times 200. So I lose about $50. But what I should also consider is that was capital tied up in a trade that did nothing for me for 4 months. So I could have used that trade somewhere else to make 2%, let's say, per month. So that should also be included in my loss. Plus the interest I had to pay for owning these shares. So if I include that in the loss, it's probably more than $50. So most likely what I'm going to do is I'm just going to roll over the call option. So I'm going to buy it back, even if it's for $5, but I'm going to sell right away the next month's call option, and the combination will give me a credit. So I'll keep doing that, the credit keeps reducing my cost basis until I'm okay to let go my shares at 25, or even wait until the stock drops back to 25, which is a possibility with Weight Watchers. But definitely if that happens again, if I have the opportunity, then I will make sure I pick a strike price that's closer to my cost. Look, as you can see, Weight Watchers today went up 42%. Does not make sense. The other thing I could do is I could buy back the call option, but then I could sell at a different strike price. So for September 20th, maybe I could sell it at 30. But as you can see here, it's going to cost me. So this one, I'd be doing it for a debit. So let's see if I go for September 13 and I go for maybe a different strike price. Let's say 27. Yeah, that would still be a debit. Let's try 26. Yeah, it would still be a debit, 25.50. So yeah, so I could probably go for September 13, pick a strike price of 25.5, which isn't a big deal, but at least I'd gain 50 cents back, and I could do it for a credit. So that could be another option. Or maybe go, let's say October 18, go to 30 strike. It would still cost me money. So it would still cost me money. Actually, if I do the September 20th at a 30 strike, it would cost me money, but I would be able to sell my shares at 30 if the stock remains above 30 come September 20th. And in fact, even if I sell my shares at 30 and I paid, let's say I paid, let's say 225. I paid 225 to get that chance to sell my shares at 30. That puts me at a cost of 27.75, as if I sold it at 27.75, which I should be happy with since my cost is around 25.25. So that could be another possibility actually. So actually I'm not in that much of a big trouble unless my shares get called away automatically from me tomorrow. We'll see. Hopefully they don't get called away. But definitely I'll buy it back and then sell another one, either at the same strike price or at a higher strike price. So even if I do the same strike price, what's good is I'll be collecting maybe 80 cents. So I just reduced my cost, which was, remember, 25.25. I reduced it by 80 cents. So now my cost is 24.45. So the next month, if I decide to let my shares get called away at 25, then I would have made a 55-cent profit, a very small profit across 5 months, but at least it's a profit. But if I could do it again, maybe if I can repeat the process for the following month, collect maybe another 80 cents, then I just keep reducing my cost basis until I'm ready to let my shares go at 25. But because of this here, I've got an equity that dropped from 7,000 to 5,000. Besides that, everything else is fine. I mean, everything's slightly going back up. The iron condors I've got on the Spider ETF on the SPY is doing much better because the SPY is going back higher. Tesla is still in the middle. I collected $1.25 on Tesla. Right now, I would still close it at the same price. So because the volatility is higher, the premiums are more expensive, but I'm still within the good range. So it's trading at 232. My range is 205 to 260. Uber is coming back up. Work is going back up. So it's really just Weight Watchers that's killing me right now. Box also dropped really hard. Activision looks like it's going to be a profitable trade for the week. This is a trade I made on Monday. and looks like I'll be able to close it for max profit on Friday. AMD is creeping back up, American Airlines as well. On the TFSA side, I think my best position right now is Grubhub. Collected a decent premium the first month, and it looks like I'll be able to collect a second decent premium the following month. Teva is the only thing that's bothering me in my TFSA, and of course IMGN, but I gave up on IMGN a long time ago. Kroger also went up, so it's getting closer to my strike of 24, which is good. So I could roll over. If I want to keep the shares and keep collecting premiums, I can roll it over. But this one's until September 20, so I still have a lot of time. Let's say I go to October 18 at a 24 strike, I could collect right now would be 30 cents. But that's because the current option still has a lot of premium left, so I'll wait until I get closer to September 20th. Today, actually, I bought, in my RSP account, I had about 1,500 available. I bought some Bombardier shares because it dropped hard. Bought it at 182, and I sold call options expiring September 20th, collecting 8 cents at a $2 strike. So come September 20th, either I'll keep the call options expire worthless, so I keep the 8 cents completely, or the stock is trading above 2. If it's trading above 2, I still keep the 8 cents, but I make an additional profit between the $2 and the $1.82 of cost or purchase price. All right, so if you have any questions, any comments, any suggestions, leave them in the comment section below. Like always, if you're going to open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get up to $250 back. Also, check out the other referral links in the description below. Thanks for watching.